Ltfoods is proving exactly what global dominance looks like in their Q3 FY26 review. This quarter is all about resilient growth and strategic deleveraging for the powerhouse behind some of the world's most popular rice brands. Looking at the performance snapshot for this quarter, revenue hit 2,812 crore, fueled by massive demand in North America and Europe. EBITDA reached 317 crore, showcasing strong operating leverage, while profit after tax grew 8% to 157 crore. Perhaps the most impressive feat is the deleveraging, with the net debt to EBITDA ratio dropping from 1.17x down to 0.95x. This top-line surge is a volume story, not just a price story. The 2,812 crore revenue was driven by a 20% volume growth in the Basmati segment, proving that real consumption demand is soaring across North America and Europe, rather than just being a result of price hikes. While gross margins improved by 30 basis points to 34.2% thanks to lower input costs, management intentionally compressed EBITDA margins by 20 basis points to 11.3%. This is because they are strategically increasing marketing spend and investing in brand equity. They aren't just selling rice, they are securing long-term market share. The core engine remains Basmati and specialty rice, which accounts for 88% of total revenue. For the first 9 months of the year, this segment brought in 7,094 crore, up 26%, with a solid segment margin of 12.6%. North America and India stand as the twin pillars of this massive consumption. In the Winning the West category, North America is the absolute star performer, contributing a 46% revenue share with a staggering 50% growth rate. Meanwhile, India continues steady with 10% growth. The Royal brand is now officially the #1 brand in the entire US market. However, not everything is perfect. The organic food segment saw a 15% revenue increase, but a margin hit at 6.0% due to new European plant costs. Additionally, the ready-to-heat and ready-to-cook segment dipped 4% with negative margins as they discontinued the Daawat Sehat portfolio. Restructuring is painful now, but it is necessary for future efficiency. The real hidden gem in this report is the aggressive deleveraging. The net debt to EBITDA ratio has fallen sharply from 1.17x down to 0.95x. With a net debt to equity ratio of just 0.27x, the company is showing incredible capital strength by paying down debt while simultaneously growing revenue by 23%. When you look at the quality of earnings, the efficiency is clear. Inventory days have decreased from 268 to 255, and working capital days dropped from 227 to 205. Most importantly, the cash profit of 220 crore is significantly higher than the reported net profit of 157 crore, meaning actual cash flow is even stronger than it looks. Capital allocation remains a top priority. The return on capital employed, or ROCE, has climbed to 20.3% from 19.5%, which is a hallmark of a high-quality compounder. Return on equity is also healthy at 15.9%, showing efficient use of shareholder money. For the price and value snapshot, as of December 31st, 2025, the market cap stands at 13,530 crore. The company has also declared its second interim dividend of 1 rupee per share. It remains a market leader in both the US and India, trading at reasonable valuations compared to its FMCG peers. Investors must still watch out for certain risks. There are potential headwinds from US tariffs and pressure on exports. Furthermore, the 2025 outlook for crop yields has been revised down, and there is an ongoing regulatory investigation regarding soybean exports. Running through the due diligence checklist, cash profit is healthier than PAT, inventory days are successfully decreasing, and the debt spiral is non-existent, with net debt to EBITDA under 1x. They even reported a transparent 5.62 crore fair value gain as a one-off item. The final view is constructive. We are bullish on their brand equity with Royal and Daawat, their US dominance, and their financial discipline. We remain cautious on near-term supply constraints and geopolitics, but the bottom line is clear. This is a resilient consumption play with a rapidly improving balance sheet. Did this fast-moving consumer goods deep dive help? If so, make sure to like, save, and share this video. Follow and subscribe ZinvestZ for more such smart investing insights. Thanks for watching.